Welcome to the debate. Today, we're digging into something crucial for high net worth planning, the strategic fallout, really, from the One Big Beautiful Bill Act, the OBBA. Now, this law seemed to offer incredible certainty. It permanently set the federal estate's gift and generation skipping tax, or GST, exemption at a new baseline of $15 million per person, indexed for inflation.
Which was a huge sigh of relief for many, let's be clear.
Right. But it brings us to the core question we're tackling today. Does this act, which importantly got rid of that looming TCJA sunset, that cliff edge where the exemption was going to drop drastically, does it actually remove the urgency for using complex, aggressive gifting strategies? Things like dynasty trusts, sales to IDITs. Are they still mission critical right now? I'll argue pretty strongly that the urgency hasn't disappeared at all. It's just shifted focus. That $15 million certainty Obaba supposedly offers, I think it's largely an illusion. We have to treat this current exemption level as a strategic window, a real use it or lose it moment to lock down future appreciation and hedge against legislative risks that, well, we know are still very much out there.
Okay. I see it, well, quite differently. The main driver of panic gifting, the absolute core legislative pressure, that was the anticipated drop to maybe $7 million per person. OABBA took that threat completely off the table permanently. So while yes, sophisticated planning is always needed for these clients, my position is that the known costs, the significant risks, the sheer inflexibility of these really complex structures, they're just harder to justify now. I think caution and flexibility should take priority over, frankly, fear-driven execution.
I understand that perspective. I do. But let me offer one grounded in, well, history and legislative reality. Complacency right now, I think it's a ticking time bomb. The data, the past proposals, they're screaming at us. Well, OBBA gave us this $15 million floor. Legislative certainty, it's only as good as the next Congress. We know that previous series proposals, like the draft for the 99.5% Act, aimed for drastically lower exemptions. Think $3.5 million estate, maybe $1 million gift tax. And they explicitly targeted the elimination of crucial tools, the very leveraged techniques we use, like GRATs and discount planning. So the goal now isn't just avoiding a sunset. It's about getting future growth out of the taxable estate. If a client sits tight, the next, say, 40 years of appreciation on their assets, maybe it's a hot tech stock, maybe prime real estate in an LLC, that growth stays exposed to a flat 40% estate tax hit above the threshold. We absolutely must push wealth out now, using vehicles like dynasty trusts to max out this exemption and shield wealth across generations.
Okay, that sounds compelling in theory, but in practice, we really need to look hard at the cost-benefit analysis after OBB. This new $15 million baseline, it's substantial. Pushing clients into irreversible deals purely out of fear, especially when the immediate tax storm clouds have cleared, at least for now, without properly weighing the very real costs and the lack of flexibility in these aggressive setups, that feels like questionable advice to me. And let's talk actual costs. Dynasty trusts, designed to last forever, these are incredibly complex legal machines. You're looking at hefty upfront legal fees, easily $50,000 or more for complex assets, plus significant ongoing trustee fees. We're talking administration, accounting, annual tax filings. Those fiduciary fees can easily eat up 0.5% to maybe even 2% of the trust's value every single year. Over 50 years, those costs can seriously erode the supposed tax savings, particularly if the underlying assets don't perform spectacularly.
That hit of doing nothing.
I'm sorry, I just don't automatically buy that the marginal tax savings always outweigh that administrative burden. And crucially, the inflexibility. These irrevocable trusts impose what we call dead hand control. Look, family situations, marriages, divorces, kids with special needs, business ventures failing, they change, sometimes dramatically over decades. A rigid trust structure locked in today might become completely unsuitable, even harmful for future beneficiaries. And that often leads to family fights or incredibly expensive court battles to try and fix it. Things like decanting, which can drag on for years with massive legal bills. That cost, the cost of inflexibility, Has to be part of the calculation, especially now that the immediate TCJA cliff is gone.
Okay, let's tackle that legislative risk directly, specifically around the very thing you're criticizing, the multi-generational GST-exempt transfer, the whole point of a dynasty trust. You're saying OBB's permanence is key, but you're skating over a huge vulnerability in the dynasty trust structure itself. We know states like Delaware, South Dakota, they got rid of their rule against perpetuities, the RAP, precisely to allow these forever trusts, right? To take advantage of the federal GST exemption. But for the 99.5% Act, that draft legislation, it proposed a federal rule against perpetuities.
It was proposed, yes. That's true.
Proposed, yes. And it would have limited GST-exempt trusts to just 50 years after enactment. If a federal 50-year limit comes into play, it basically wipes out the entire multi-generational tax shield, the very advantage you're paying those high ongoing fees for. This benefit could vanish overnight for trusts created after such a law passes. Retirees, I think, are sleepwalking toward a potential disaster if they don't lock in these GST-exempt transfers now under current law before Congress possibly yanks the rug out from under the whole concept of perpetual exemption.
That is a compelling point. Definitely a risk factor. But let's game out the financial result of that panic gifting scenario you described. If Congress does impose that 50-year limit, clients who rushed into these super complex, expensive perpetual dynasty trusts, well, they've paid all those high upfront legal and setup costs, plus years of administrative fees, for a benefit that gets chopped off prematurely anyway. The structure is still complex, still costly to manage, but the main selling point, the duration, is gone. And what's more, the very techniques we often use to maximize these gifts, like transferring fractional interests in LLCs or partnerships to get valuation discounts, those are also prime targets for legislative change. If the rules on discounts get tightened, the whole structure becomes less tax efficient, but the high complexity, the administrative burden, that sticks around. It could become a real albatross.
But that complexity, even if it's expensive, it's a function of the alternative, that 40% tax. You brought up valuation discounts, gifting those non-marketable interests to stretch the exemption, maybe by 35%. Yes, doing that properly takes meticulous planning, detailed records, costly qualified appraisals, sometimes tens of thousands just for the appraisal, to justify that discount. And you're right, clients then have to deal with the ongoing compliance burden, filing the Form 1041 trust returns, managing complicated basis tracking.
Exactly my point. For many high net worth clients, maybe someone worth, say, $20 million, not $200 million, the time, the stress, the sheer headache of setting up and maintaining this administrative machine, plus giving up control, it might simply outweigh the tax benefit now that they have a solid $15 million exemption already secured by OBBA. That operational drag is a real factor.
Look, I'm just not convinced by focusing solely on the inconvenience when we're talking about mitigating a 40% wealth transfer tax. That's the financial imperative. Yes, the strategies are complex. They have to be for the tax arbitrage to work. And, that's exactly the gap I see constantly, not just in estate planning, but across sophisticated financial strategies, whether it's multi-million-dollar trusts or even just high-level portfolio diversification for our affluent retirees. Most high-net-worth Americans, folks sitting on $100K, $250K, $500K or more in their IRAs or 401Ks, or those planning these big estates, they understand the why. They see the legislative risk, the economic uncertainty. But the how? That's where everyone seems to get stuck. Dealing with the complex mechanics, the valuation issues, the rollover logistics, avoiding costly mistakes during implementation. So here's something we've actually put together to address that exact complexity hurdle, even in areas like how you allocate assets within these trusts or retirement accounts. There's a comprehensive free gold IRA guide linked right there in the description below. Now, it's specifically designed for Americans who have at least $100,000 in retirement accounts. It really walks you through all the benefits of adding hard assets like gold to your retirement portfolio. It covers how the rollover process actually works, what the real costs are, no hidden fees, the different allocation strategies people use, and crucially, how to avoid the common pitfalls and mistakes we've been debating today in terms of just getting paralyzed by the details. It's a really solid foundation, Honestly, it takes about 15 minutes to get started once you grasp the mechanics. Now, here's something special for this week. If you qualify, and that's typically based on account size and just frankly seriousness about exploring this, there are only 7 free educational web conference spots available this week. These are no obligation calls. They go much deeper, really personalized to your specific situation, showing how these complex steps apply directly to you. There's no pressure, absolutely no sales pitch. It's just pure education on how this works for your circumstances. Qualification happens through the guide download process itself. Alternatively, you can call us directly to check on qualification and availability at 877-607-9367.
Okay, while simplifying the mechanics is always useful, the fundamental problem I keep coming back to with these aggressive transfer tax strategies is the irrevocability. Dynasty trusts, by design, strip control from the person setting them up, the grantor, to get the tax break. But that inherently creates massive inflexibility down the line. Look, if assets were gifted outright, okay, they might be vulnerable to a beneficiary's creditors or a messy divorce. But the trusts themselves, they are often nearly impossible to change when life inevitably throws curveballs that demand adjustments. We have to prioritize flexibility and control now that the immediate TCJA cliff has been permanently removed by OBBBA. That pressure is off.
But there's another layer of urgency we need to discuss: anti-clawback protection. Now, the IRS did confirm that outright, fully completed, irrevocable gifts are protected. They won't get clawed back and taxed later if the exemption drops below the $15 million someone used today. But, and this is critical, that protection is explicitly questioned for gifts where the donor keeps some kind of string attached, some interest or control, things that fall under IRC sections 2036, 2037, or 2038.
That's a very important distinction, absolutely.
Yes, and it directly impacts common leveraging techniques like using a grantor-retained annuity trust, a GRAT, or a qualified personal residence trust, QPRT, where you transfer your home but keep the right to live there, which falls under Section 2036. The anti-clawback safety net only applies to what are called adjusted taxable gifts. So we need to complete these transfers fully, irrevocably, now to make sure they qualify as such and lock in today's high exemption. This is especially true for strategies where you might otherwise keep an interest for a set number of years. If you hold on to that string, the whole value could potentially get pulled back into your taxable estate at death.
That's an interesting point, though I'd frame it, well, slightly differently. The very risk you're highlighting is precisely why these complex leveraging strategies should be approached with maximum caution now. The anti-clawback protection, it's crystal clear for truly completed gifts, no strings attached. But the second you structure a gift that might be pulled back into the estate because of a retained interest, like your GRAT example, if the client unfortunately passes away during the trust term, you lose that protection. If they die during the GRAT term, the assets could be included in their estate and taxed at whatever the rate and exemption are at the time of death, not when the gift was made years earlier. So the trade-off for using these fancy leveraging tools is potentially losing both the benefit of using the high exemption and the security of the anti-clawback rule. If OMBBB has lessened the need for such extreme leveraging, then doesn't the risk-reward calculation shift dramatically towards simpler, fully completed gifts, where that protection is guaranteed? Why take the clawback risk just to squeeze out a bit more leverage from an exemption that's already quite generous at $15 million?
Because the $15 million exemption itself is only part of the story. It's relevant until the assets appreciate. Our focus has to be on removing all future appreciation from that punishing 40% tax bracket. If a client has assets that are really poised for significant growth, say $10 million in assets today that could reasonably become $50 million over the next 2 decades, using every available leveraging tool now, even the complex ones, even those with some clawback risk if not perfectly executed, is the only way to potentially shield that entire $40 million in future growth from transfer taxes. The $15 million baseline doesn't solve the growth problem. Aggressive, immediate gifting does.
And I still maintain that the steep price of that aggression is often the erosion of control and flexibility. And in the real world of managing wealth across generations, that frequently leads to more family strife and higher administrative costs than the tax dollars saved, We should be using the robust $15 million baseline OBBBA gave us as a powerful tool to make simple, clean, outright completed gifts. Gifts that guarantee anti-clawback protection and minimize the administrative drag, rather than defaulting to the most complex, highly leveraged structures driven mainly by fear of a legislative repeal that OBBBA made less likely.
Look, the debate really boils down to risk tolerance and seizing an opportunity. This high $15 million exemption, it's a strategic gift from Congress. And history repeatedly shows these gifts can be fleeting, subject to being snatched back by proposals like that 50-year federal wrap. The chance to permanently shield millions in future growth from the 40% estate tax using dynasty trusts and IDITs, I see it as a strategic imperative that justifies the planning complexity and the cost. Complacency means passively accepting significant and, frankly, unnecessary wealth erosion from future taxes and inevitable policy shifts.
And while OBBBA certainly didn't eliminate the need for smart, proactive planning, it absolutely restored a margin of safety that the TCJA sunset had stripped away. We agree, I think, that locking in transfers is vital for those well above the threshold. But high-net-worth clients now must weigh the known, long-term costs and the inherent inflexibility of these very aggressive, irrevocable strategies against a policy risk that OBBBA has undeniably significantly reduced. Thoughtful planning today should prioritize flexibility and minimizing complexity, not just squeezing every last dollar out of the exemption based purely on legislative fear-mongering.
The optimal path involves balancing tax efficiency with administration, yes, but that crucial first step, using the full exemption now, is paramount. That has to happen regardless of what next year's Congress might dream up. The time to lock in that potential future gain, shield it from tax, is right now.
And the time to lock in control and flexibility is also right now, especially given that the immediate tax cliff has been indefinitely postponed. Achieving that balance requires ongoing review and truly sophisticated, tailored guidance for each unique family situation.